Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money weekly roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
Right. Now, when we say the stories, this week we don't really mean the stories. We mean the story, because there is only one. Well, in our little niche, there is only one. And that is what's going on in the UK investment trust industry. Now, earlier this week, John spoke to Boas Weinstein, Chief Investment Officer and founder of Saba Capital Management. If you haven't listened to that episode, go and listen to it, because it sets us up for what we're going to talk about today. In a nutshell, Weinstein and his firm Saba Capital are attempting to take control of 7 UK investment trusts because they're trading on high discounts, or have been trading on high discounts, their net asset value. Maybe their returns have been a little rubbish. Maybe their governance is all it should have been, etc. So they want to take control of these trusts. We're going to talk about what that means and why maybe they should, maybe they shouldn't. Who knows? Anyway, since we published that podcast with Weinstein, some of the trusts that is looking at have contacted us and said, look, do you know what? This isn't all right. He said some stuff that may be misinformation, maybe not information. We don't agree with what he says about this. We don't agree with what he said about that. So we want to have our say. Now, we can't have all 7 chair people of those trusts on. Well, we could, but it'd be kind of chaotic and slightly carnage-like. So John and I are going to run through all the concerns that everybody has and try and come to some kind of conclusion towards the end. Now, one thing I want to add before I do that is that regular listeners will know that I am on the board of a couple of UK-listed investment trusts. Neither of these trusts are on Sabas lists, so it's not relevant, but there is, that's out there. I've got some skin in the investment trust game. I don't think I'm conflicted anywhere, but, I'll leave that up to you. Now you know. Right, John, do you know what I think?
What do you think, man?
I think I've had too many emails on this.
Sorry. I love that they sent them all to you. This is the great thing about being able to kind of just come on, do an interview, chat away to someone, rile everyone up, and then you get all the complaints. It's fantastic. It's like Bitcoin all over again.
It is Bitcoin all over again. And a couple of people would like me to do something about you. Like the Bitcoin people would like you to do something about me. So I'm not going to do anything about you as long as you don't do anything about me.
I think that sounds like a good deal.
Okay. The other thing I think is that I have got so many windows open on my desktop looking at this. There are so many different views. And do you know what I really think in the end?
No.
Everybody's right. Absolutely everybody is right. Everybody who has written to me, everybody who has telephoned me, contacted me on LinkedIn, abused me on Twitter, everybody has a point about this. It all comes down to, do you think it's reasonable for an investment trust to trade at a discount? Do you think long-term is 3 years, or do you think long-term is 5 years? Mm-hmm. What do you think a reasonable fee is? What does governance really mean to you? Et cetera, et cetera. Do you think that the investment trust industry is such an important part of the UK investment and finance ecosystem, and in particular, maybe even the startup ecosystem, that it should be somehow protected in a way that other companies aren't, etc. And there are great arguments on both sides for this. Now, on the same day that we released your fascinating chat, by the way, with Boas Weinstein, would you actually like to have my job? You do this really well.
I know I couldn't possibly. I mean, for a start, I might start getting some of the complaints directly.
They'll always come to me. Anyway, the same day that we put that out, Boas Weinstein also had his own webinar, where he talked for over an hour about why he's doing and what he's doing. And it's quite rude about a lot of people, quite rude about a lot of directors, very rude about quite a few fund managers. And he talked a lot about things that, not everything he said was stuff that I would have agreed to. He talked about the principal agent problem, about how the manager is the agent, and in all these trusts, the manager has no stake, no skin in the game, and the manager is just there to protect the assets, etc. All true. But that's what the board is there for. The board represents the principal. And while boards don't, in the main, own very many shares relative to institutions, because boards are individuals, right? So if you own £10,000, £20,000, £30,000, and in some cases much more of a trust, you've got to put a reasonable bit of your personal money in it, but obviously it's nothing compared to what the institutions might have. So it's skin in the game, but not in an institutional kind of way. So there was some confusion that irritated me a little. Got to say, Boaz, this did irritate me. Confusion between the manager and the board. And I think, in my experience of this sector anyway, that boards are very good at remaining independent from the fund manager. So that irritated me a little. But I did, I got the general idea that in the main, what a fund manager wants to do is hang on to assets. That's what they want. Most big fund managers are asset gatherers. They want to get money, keep money, take the fee on that money. And in that sense, investment trusts are very good for fund managers because that money is trapped. Unlike an open-ended fund where that money is not trapped, investment trusts are great because they just sit there, little pool of permanent capital, take your fee every year. So, that's one thing he said that really made sense. It also makes sense to say that the trusts that he is targeting do have horrible performance over 3 years. Horrible. And if your time frame is 3 years, then you would certainly look at some of the Baillie Gifford stuff and you'd go, why on earth am I holding this? Why can't they make it better? Why have they lost 40, 50% of my money over 3 years? This is horrible. Of course, if you look at it longer term, not so horrible. And if you approve the strategy, then, you're going to give it another 4 or 5 years before you start to lose your temper.
Yeah. I mean, I do think, and certainly from our conversation in the interview, but I did make the point that the last 3 years particularly, that's when interest rates started rising. There are good macro reasons why performance would be specifically bad over this time period. And I also think if you are quite careful about the starting date that you choose, you can choose a date before the big sell-off happens so you can make it look even worse than it is. I mean, that's one thing you notice whenever you're messing around with charts in the Bloomberg terminal, that if you change the starting date, it can make a substantial difference, even though you're broadly making the same sort of point. But whenever I did sort of say, I said, so what about this 3 year thing? And they said, you're a very, you're a very forgiving investor. So I was sort of thinking, in the hedge fund world, 3 years is probably eternity. Whereas in the investment trust world, 3 years is a relatively short time frame.
Yes. And I do think, by the way, everybody that going in and watching, and obviously listen to John's podcast first, but then do go and watch Boaz Weinstein speaking, because there's a lot to argue with, but there's a bit where he says, and I'm sorry about this, I don't want to repeat things that make people feel a little sad, but he says to Baillie Gifford, aren't you embarrassed? Aren't you embarrassed? And this is very feisty stuff. Baillie Gifford is one of the big and most respected fund managers in the UK, and he pulls out their 3 years performance, and actually it looks over 3 years in a couple of places, and he says, look, aren't you embarrassed by this? Look what you've done. Look how much money you have lost your investors. And, it's potent stuff. It's true, because this is real money. If you invested at the top, that's real money that you worked for, that you saved, and it's gone. It's gone. And there should be a response to that.
I agree. And I think that, while you can have discussions and make excuses and all the rest of it, and again, it's always possible to do that. At the end of the day, the job of fund managers fundamentally is to look after their customers' money and make more of it. And the fundamental favour of all of these trusts is that none of them are necessarily, they're not benchmark huggers. But the problem is, I do think there is a fair point where if you've been sort of viewed as a techie, growthy fund in the last, 3 years, and you still struggled to come up to the S&P, especially if most of your investments are in the US, then that is kind of hard to explain away. Basically, if you'd been better putting all your money in an S&P 500 passive tracker with the rest of the population over this time period, then you do probably have a right to feel a little bit fed up.
So there is this key thing here. There is a problem in the sector. A lot of the discounts in the investment trust sector, they have become structural. They're there and they haven't gone away. And 3 years is too long. And we did have, and I'm sure that everyone in the industry will have read it, there was Alan Briley of Investec put out a note last year where he pointed out that this stuff is beginning to be a problem. He said, it wasn't last year, actually, it was the year before, October 2023. And I remember it coming out and him saying, look, we've got an end of cycle challenge here. There are various exceptional events going on, but this is a perfect storm and it comes with some self-inflicted wounds, and you lot have got to do something about it. You haven't responded fast enough to all sorts of things. There's discounts at multi-year highs. There's blood in the water. This is going to attract arbiters and it's going to attract corporate buyers unless you do something about it. You've got to do something about your discount to get out there, create tenders, buy back properly, make sure these discounts come down to levels where you are not going to be attacked. And of course, the sector did not react fast enough to that advice from Investec a couple of years ago. And here we are. So is there a problem? Yes. Does the investment trust sector need to find a way out of that problem? Yes. But is Saba the answer? Is Saba the answer, the solution to that problem? And I would say, so far, in part, yes, because here we are having this conversation. Here we are having it. And already, the trust that that Saba has targeted are already putting forward, well, they wouldn't they, putting forward various strategies to deal with it. A strategic review from one of them, putting dividends up, offering cash exits, talking more about discount management. The Edinburgh Worldwide Trust has been talking about a big capital return next year. BG Growth, actually nothing. One of the others, nothing. Herald, nothing. But Keystone has put in place, or was attempting to put in place, a full cash exit for everyone, which now it can't really do because of this business with Saba, who aren't going to vote for it. So they are now putting in place some things, and you'll see other trusts in the market looking around and going, wow, we might be next. We got to do something. And really stepping up buybacks, or certainly talking about stepping up buybacks. So we have a catalyst here. We have a catalyst that is forcing boards to sit down and say, what can we do to deal with these structural discounts? And it's very hard to turn around performance in 5 minutes, right? But you can maybe do something about the discounts. And if you can't, let's say you buy back and buy back and buy back and buy back, and the discount remains, and your trust becomes very small, well, maybe that's just the way it is, right?
Yeah, I mean, I think the most obvious value that Saba has added is to put a rocket up the backside of the sector. I think that I don't think really can be argued with, and to be fair, I don't think anyone really is arguing with it. These trusts have taken action. The other trusts that are sort of on the hit list, some of them are taking action or at least talking about it. And I think that in itself is good, because also, it draws attention to the sector. Now, the UK capital market as a whole, we've been complaining about for quite a while. It's had nearly 4 years worth now of consecutive withdrawals. But the point is that this sort of thing, where somebody's noticing the value, and it's happening, it's like, Herald has gone from trading on a discount of, I think it was around about 10% for most of last year, and now it's trading on a premium of like 1.5%. And to be fair, Herald is probably one of the most, one of the trusts on this list that I would sort of feel it would be a shame if it was taken over, although we can discuss that in a moment. But the point is, it was trading at persistent discount and now it's not. So Saba has been good for shareholders in that trust and in all the other trusts, because they've all kind of seen their discounts close. So there's definitely been value to that. And I think the only question from the ultimate point of view of our listeners, I guess, who are the people who hold investments in these trusts, your kind of retail investor, what's the next step, and what does it mean for them, if Saba wins or if Saba doesn't win?
Yep.
And from that point of view, I think that's where it gets slightly more complicated, just because, at the end of the day, if you were fed up with Herald and you were waiting for the discount to close before you got out, well, now's your chance. You should sell today.
Job done.
Aye.
Job done. Get out
sorted.
now. Absolutely.
Aye.
Absolutely.
But also, I would also like to know, for example, if you were in Keystone which is, I don't think even the chairperson would argue that performance in that has been bad. So a part of me also does wonder, like, what are you thinking if you are currently a Keystone shareholder? Why is it still in your portfolio at all? It's like, I do think there's got to be an element of people taking responsibility here, because one of the things that everyone keeps talking about is that there are a lot of retail shareholders on these registers. So a lot of retail shareholders own them. And one of the arguments is that Saba has come along, and because you need to get 50% of however many votes are cast, Saba's got like 30% already, or nearly 30% in most of these trusts. And so when it goes in and votes, if most of the retail shareholders don't turn up, then they're automatically going to win. And obviously people keep saying, well, retail shareholders are apathetic, but I'm not sure. I don't actually really understand that. You have to be a fairly active investor to have ended up in any of these 7. You have to be someone that chose to buy them. You're not getting put into this by your auto-enrollment pension. So if you don't go out and vote, or if you don't even, if you don't have an opinion and you're not aware of this, then what are you doing with your portfolio? It's like, why is this stuff there and you don't know about it? It's not that hard to vote.
Yeah, but it's interesting, John, on this business of voting, and that several people have said to me over the last couple of days, this is so awful because poor retail investors, it's so hard for them to vote. Well, it kind of isn't. Interactive Investor has been operating an opt-out rather than an opt-in system for years now. Hargreaves Lansdown, AJ Bell, etc. They all have very efficient voting systems. If you want to vote, you can vote. Now, if people don't vote in this, I think it'll be very interesting. And then you and I can do lots of great podcasts on shareholder democracy and what's wrong and how people should get on with it, etc. But I have had one from the Share Society, an email from them about the problems with the nominee system, i.e. the way that your shares are held on platforms, so you don't hold them directly. The platform holds them for you, and ownership is slightly fuzzy. And they believe that there are problems with communication. So it's actually very hard for trust boards to directly contact shareholders. So I would say the main problem there is communication. And if I were to be allowed to reform the system, I would try and make it easier for companies, and trusts, of course, are companies, to communicate directly with their own shareholders, even if they hold their shares on platforms.
You're right, Lo, because a lot of this, I've never, ever seen a campaign as aggressive as this to get shareholders voting, which again I think is yet another indicator of some of the potential problems in the sector. It's like so now that your job's at risk, you're getting the finger out to make sure that your shareholders come and vote. I'm fascinated to see what the turnout is like, because I think that it will be a really strong test of the points that, in your book about shareholder democracy, share power. I think, and actually it's really exciting from that point of view. Very much looking forward to it.
Exactly. I know. I'm slightly embarrassed about being excited about it, because really, I should be horrified and appalled, etc. I'm kind of excited. Okay, so that's voting out the way, why you should do it, etc. So now the question is, what should you do? How should you vote? What is Saba actually trying to do here? And I had the emails, relentless, John. I had one from someone in the sector who said that, what Saba is doing is perfectly valid, but he really wishes that Boris Weinstein would drop the mom and pop stuff and all the talk about how he's the white knight and the defender of the retail investor and all that stuff, when all he's actually doing is a perfectly reasonable arbitrage.
Yeah.
That's it. And he's doing it ruthlessly. He's using these discounts to arb the difference between the NAV and the market price, and at the same time to gather assets. And if you look at the asset gathering part of it, we had some communication with Karen Braid, the chair of Keystone, and her core question is, if you are the white knight, if you are the great protector of the retail investor, Keystone has already offered a full cash exit for all shareholders who want it at net asset value minus 1% obviously being to pay all the expenses of doing the whole thing, etc. Now, as that is already on the table, if Saba wants everyone to get out at full value, why are they stopping this happening? why stop Keystone investors reclaiming their funds first? And then people who want to go to your own offering, then they're left over for you. If you're not doing that, it rather suggests that the whole thing that you're trying to do with Keystone, at least, is simply to gather assets in order to reap the fees from that later.
I have a struggle to see what is I don't know what the comeback is to that. I think
I don't know, but I do
reasonable.
just want to interrupt because I'm slightly concerned that Boaz is listening to this. Boaz, I would like you to send your hate mail to John.
You do it on Twitter. It's much more direct.
No, but on Twitter it's going to come to me.
Oh, yeah. That was the point. But but I think that's not an unfair point. Okay, but the mom and pop stuff is part of the ruthlessness. It's an aggressive sales pitch. If you argue that they're relying on shareholder apathy, then on the flip side of that is, well, why are they coming on like this podcast? I would keep quiet. If I was relying on shareholder apathy, then I'm not sure I would publicise this as much. So maybe, there's an element of hearts and minds alongside. Of course, if they've targeted these 7, then they want to win them all. And obviously they make money off the fees, so you want as many assets as possible.
If we won the lot, it would be 4 billion quid.
Yeah, that's nice.
Could be quite a trust of trusts, wouldn't it?
I mean, that is the other thing. It's like what they're planning to do with it, I guess, is where, it's where quite a bit of the criticism comes from, but also it's where, I guess, my own view, and you understand boards a lot better, but some of the mechanical aspects of this, like how do you liquidate these portfolios without driving down the share prices, for example, and things like the kind of the governance. You're going to have to overhaul these entire kind of structures, and is that not going to distract to the point that possibly it's going to be detrimental to performance? I mean, I don't know, but I think that the changeover process is bound to be disruptive and complicated in ways that are not clear right now.
Well, that's a good point, and changeovers are always disruptive. But a lot of the stocks held in a lot of these portfolios are perfectly standard liquid stuff. And he has said that there would be, were he to get Herald, there would be a year for the liquidation, etc. And the big one in Bailey Gifford, the private company, of course, is SpaceX. And as he himself says, I'm pretty sure there's a market for that.
Yeah, and that is fair enough. And I can see why they would actually want to keep that anyway.
Yeah. So more of the question is, there are governance questions. There are, does Saba Capital really understand exactly how intense the compliance and regulatory burdens on trust boards in the UK are? It's not normal and not acceptable to simply have 2 non-independent directors on a board. It doesn't work like that. And he has said that over time he would get more directors onto his new boards, etc. But starting out like that, 2 non-independents, it's not ideal. That's not how we work. So there are governance issues around that. Although he says they'd be short term, one would hope they would be short term. And then there is the matter of the new strategy. And again, I think I'm slightly less bothered by this than some other people in the market, because it seems to me that Weinstein is suggesting that in almost all cases there would be an opportunity for people to get out at a few percentage points, at least below NAV. So it's not necessarily compulsory to roll over into his new strategy, which slightly suggests that all the arguments about his performance record and his fees and all that kind of thing, if you can get out without having to go into that strategy, how effective that strategy is and how much it costs is slightly moot.
Yeah, I think that's true, and I think that's all fair enough. And I guess from the point of view of voting, I suppose my issue again sort of comes back to what you're thinking as a shareholder of these trusts. So it's like, if you own Herald because you want to take advantage of small cap global tech stocks, and that's actually a strategy that you believe in, then I struggle to see why you would be keen to swap that out for a strategy of closing investment trust discounts in the UK.
Yep.
But again, with some of the other trusts, you're kind of like, well, they've got less sort of, I guess, specific, like Herald and CQS seem like quite unique trusts in terms of what they're aiming for, whereas some of the other stuff, and also the kind of ones that are already getting rolled over, my main question to a shareholder in them is like, well, you should revisit this and think about, well, why do I own this again? And then think about what you want to vote for in light of that question. Because like I said, I mean, certainly something like Keystone, which is going to be sold anyway, I think maybe have a wee look. If you've got that in your portfolio, look at other things that you've got in your portfolio that maybe you haven't thought about for a while, and think about, well, why is this stuff here in the first place?
John, I think you're being quite polite there, aren't you? You're actually saying something incredibly rude, but in quite a polite way.
That's the best way to do it, I've been told. I got called up to HR the last time I did it the non-polite way, so I thought I better not.
Okay. So one thing that I don't think John and I are going to do here is to slog through the very tetchy discussion about everybody's performance and what is Saba's actual performance over 3 years, 5 years, 10 years, what are the actual fees, what is this, what is that, because I think that we might work on the basis that Weinstein and Saba will be reasonably good to their word and give everyone an exit. So I suppose John's question is the right one. Would you like to have some cash back at maybe only a couple of percentage points below NAV? And by the way, in most of these cases, you can have that right now.
Yeah.
You can have it right now. So if all you want is to get out with your cash relatively intact, I mean, obviously not if you've lost 30, 40, 50% with one of the funds, maybe if you went in the top. But either way, you want to get out close to NAV, just do it now. And then, you know what? If you want to go back into the Saba strategy later, assuming he wins one of these, he'll have a listed vehicle and you can buy back in when all the chaos is complete. So that seems like a great way to do it if you actually want to be in the Saba strategy. Take your money, wait, buy back in later. If you don't want to be in the Saba strategy and you do want to stick with, for example, Herald or whatever it was, then you need to get out there and vote to hang on to the strategy that you like. Is that a fair end interpretation, John?
Definitely. I think that is the important thing, because that was the other thing that jumped out at me whenever I was having the discussion with Boaz. Was I mentioned the kind of saying about how, or the cynical view is that you think that retail shareholders won't vote, and he basically agreed, not in so many words, by saying, well, the alternative view is that if the retail shareholders don't vote, it's because they're not engaged enough with the current management and they don't think they're doing a good job. So, he basically said, yes, a no vote, and if you don't show up, it's a vote for Saba. So vote one way or the other.
Well, it's true. I mean, same with politics, right? Not voting is the equivalent to voting in the end.
Yeah. Very deep.
Very deep. Yeah. Boy, do you get insights on this show. Is there anything else we need to discuss? I suppose one thing I would say is there's been a lot of conversation about the importance of the investment trust industry as a whole to the UK financial sector. It's important that it's there. It's got all the infrastructure around it, and in particular the companies such as Herald that invest in small companies and growing companies and are part of our startup infrastructure, and how important that is. And I agree that it's very important. Absolutely it is. However, the key purpose of a fund or trust is to make money for its investors. You can't just be part of the ecosystem. The ecosystem alone is not enough. You have to make the money. You have to fulfill the requirements of the people who've given you their money. So it's not enough just to talk about how we have to protect this sector because it's so important to the UK ecosystem. That's not enough.
No, it's not. And the other point is that the thing that sharpens these things is competition and events like this. The fact that Boaz Weinstein's able to do this demonstrates that something has been going wrong and hasn't been addressed quickly enough. And I guess that's the point of a free market. And I guess maybe we're just not used to free markets functioning in this way.
Oh, more depth.
Worth every penny you pay for it.
Thank you, John. Right. So there we go. The key answer here is that everybody is right and everybody is also wrong. And that is my final insight for the day. Make your decision, but whatever you decide, get out there and vote. This is important for shareholder democracy. It's important to the trust if you want to stay involved with that trust. And it's really important to the fund managers who run those trusts. I mean, they don't want to lose this money, do they? Think about them. Think of the fund managers. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Saba and Moses Andem. Sound designed by Blake Maples. And our executive producer is Brendan Francis Newnham. Question and comments on this show and all our shows, always welcome. Our show email is merrynmoney@bloomberg.net. But obviously you can send your hate mail direct to John and me on Twitter.